not a very good picture that you're painting for us at this point in time. We're sitting for January year-on-year growth rate at 1.4%, lower than the 3.1% for December.
Yes, Eleni, it's the trend that started in round about the middle of last year. We had a mini recovery in the first half of last year because of the big interest rate cutting in 2009. But since then, the stimulus has worn off. The Reserve Bank's gone a lot slower on rate cuts. The household sector is still under financial strain. And so, yes, unfortunately, it's more of the same. It's a slowing rate of price increase, and it's looking increasingly like we may just have a little bit of price deflation year on year again as well.
Well, it's quite fascinating because you're also putting it down to the supply-demand curve that we're seeing currently in the property market. And at one point, we saw excess supply, and now we're seeing perhaps, little supply at this point in time and more demand.
No, it still shows excess supply, very much so. Our valuers, they rate demand and they rate supply in the areas. We aggregate the whole lot. They're telling us that demand is weak relative to supply. Our estate agent survey tells us that the average time on the market is still near to 4 months, which is long. So very much an oversupplied market still.
So still the same, it's the same picture that we saw about 2 years ago.
It's, yeah, I mean, in between, as I say, we had a little bit of better times late 2009, early last year, but very much over the last couple of years, nothing much has changed at the moment. It's on a slowing trend, unfortunately.
Well, when you look at the overall prices that are currently on the market, it seems that a lot of homeowners are still not willing to go to the market as well because they're worried about the price that they're going to get for their home. Are you also finding a lot of resistance on that front?
It's tough to know how many people don't want to go to the market or sell their houses. Obviously, it is a bad time for sellers. But what I can say is of those that are selling their houses, they wait a bit longer than what they should wait in a healthy market, i.e. nearer to 4 months, 15 weeks and 6 days. In a healthy market, you would expect about 2 months or below time on the market. And of those that have to, 80% of those selling are ultimately forced to drop their asking price. So still, by and large, an unrealistically priced market.
Okay, John, well, just looking at the interest rate environment as well, we keep talking about the interest rate cutting cycle coming to an end, and we could even face an interest rate hike towards the end of the year. Is this also spurring the flow of things in the property market?
Well, I think it may do during the course of this year, possibly not yet. There's been a lack of stimulus, and by that I mean that, yes, rates haven't been rising, but the rate cutting has been slower since 2009. That already has dampened the market somewhat. And I think if we look to this year, we're expecting sideways movements in rates for the whole year, hiking only to start in 2012. CPI inflation bottoming out, not problematic yet, but the governor in her MPC statement did warn about some inflationary pressures brewing. So we think that's about the end of the line from a rate cutting point of view, and therefore, unfortunately, still a very flat market for the course of 2011.
We had some credit numbers and money supply figures out yesterday, and perhaps even showing the fact that we're not really seeing massive credit demand coming to the fore. Credit cards, and the giving out of credit as well, very light at this point in time. This is obviously also going to have an impact overall, and banks are just not lending as much as they were.
Well, no, banks definitely not. A few years ago in the boom times, household sector credit growth was growing at a 20-something%. Now it's growing at about 6 point something%. So yes, very muted. But remember that it's about credit growth relative to disposable income growth, and disposable income growth is also muted. So what we actually saw, despite the perception that banks are very conservative, in the third quarter of last year, the Reserve Bank reported an increase in the debt to disposable income ratio. So I don't think that relatively cautious lending stance of banks is out of line with global and domestic economic realities. The fact is we have a slow moving household sector in terms of income growth, and therefore we need to cut our coat according to our cloth.
And John, I mean, you were talking about deflationary environment perhaps experienced sometime during this year on the housing front. What kind of levels are you looking at here?
For the year as a whole, I expect the average price to be close to 0% change from last year. But towards the middle of the year, you could have about 3-4% year-on-year decline or so. I don't expect the bottom to fall out of it. We had a mild deflation 2 years ago. Last year in the second half, we had some mild month-on-month deflation. And I think that's how the market is slowly correcting or adjusting to weaker economic times. It's a gradual process. So I don't expect the bottom to dramatically fall out of it.
And at one point last year, we were telling consumers out there, go out and buy. This is a good time to buy. Prices are still relatively low. So in other words, what you're telling us, they still have a year to make that purchase.
It's a relatively good time to buy. I don't think we'll ever time, or some people will be lucky to time the bottom of the markets, the big cycle correctly, but it doesn't happen for a lot of us. It's very difficult. I think, yes, this year, for those who are financially well resourced, and if interest rates do rise next year, still a good buying opportunity, possibly for 2 or 3 years ahead. I think the next time we're going to get a decent performance in the property market will be the next interest rate cutting cycle after the next hiking cycle, and that's probably a few years away.
So in other words, if we do see an interest rate hike towards the end of this year, we might see more depressed prices coming to the fore in 2012.
I think that's the reality. It's an unbalanced market as it is now, and it's a financially stressed household sector. So any pressure from interest rates, I think, causes downward pressure on prices at the moment.